Hi, welcome back to Real Estate Weekly. I'm Brian Stuckey along with Scott Rule. Scott's been a frequent guest on our program. He's been in the insurance industry for 31 years. I know the whole family very well. Is there anybody in your family not in insurance besides your sister and your mother?
Actually, my brothers both work with me now, so it's
I know
pretty
that.
nice.
So
No.
So it's a wealth of. We were discussing earlier, joking around that when you were 5 years old, your dad was explaining what a deductible is.
Yes.
But Scott, I want to talk a little bit about maintaining your homeowner insurance. I know as a homeowner and a lot of people that they purchase a homeowner's insurance because they need to as part of getting into a home, but they really, when it gets right down to it, they don't know what exactly it entails and how to maintain it. What would you suggest?
And a lot of people aren't getting advice from agents. A lot of people are buying their insurance directly from an insurance company. Mm-hmm. And I get probably 2 calls a week from somebody who will have had 2 claims in 3 years. Mm-hmm. And one of the claims was a small one, and if they'd known they were going to be canceled over turning in 2 claims, they would not have turned the first claim in, or the second claim. Mm-hmm. So my advice is, these days, to raise your deductible. If 2 claims will get you canceled in a 3-year period, and if you're my client and you call and say, I have this small claim, I'll say to you, okay, we can turn the claim in, but if you have another real claim in the next 3 years, it could cause you problems with your insurance. Mm-hmm. And my most common response is, well, it's not that big a claim, I'll just take care of this one. Well, if you're not going to turn in a small claim, buy a higher deductible, get savings back on your insurance costs, and then that will help cover, if you ever do have a claim, the amount that you've increased your deductible. Okay. I think $1,000 for most homeowners, $1,000 is the best buy.
Okay. Now, when you talk about claims, what are the most prevalent claims that you see that come in?
Water damage.
Mm-hmm.
Water damage, some wind damage, trees, like in this last storm, trees are being blown over onto homes and so forth, and theft. Mm-hmm. Those are the top 3.
Now, one thing we had talked about before, too, is that a lot of it is based on the homeowner's maintenance of the property.
Right.
Now, I'd mentioned before to you, in the lobby there, about I have a sump pump in my house, and it's broken. And so you mentioned now you need to replace that because that's a maintenance thing for you.
Right.
What's the difference between a maintenance thing and something that you guys would cover as an insurance agent?
Well, like your oven breaks down, you might have a warranty if it's a new home that you've just purchased. They'll have a warranty on the appliances in your home. That's not insurance. Insurance, if your oven breaks down, you'll need to call somebody to fix your oven, or if you're a dishwasher, call Dr. D. Insurance isn't for that. Insurance is just for unforeseen losses that happen to your property that damage your property itself. Mm-hmm.
Now, when you mentioned water, though, when you said water damage, and that's, again, I just wonder if you check in and say, well, the reason why you've got water damage is because you didn't clean out your gutters. So therefore, is that a liability onto the homeowner?
Usually you don't see very many claims from a clogged gutter on the outside of the house, but the most common is that you'll have shingles blown off your roof, and during that time, water will get into your house, damage the interior, and that's a common claim too. Mm-hmm. So some insurance companies go out and inspect roofs just so they can try to help homeowners avoid those types of losses.
Okay. Now, I want to kind of change gears a little bit. We live in California, and we had talked about last week, we talked about mold. Now, mold is the hot issue right now.
Right.
But before, a little while back, it was an earthquake. So earthquake insurance, would you recommend that?
I look at earthquake insurance as a protection of your investment. It depends upon how much equity you have in your home. If you have virtually no equity, if you did a 100% loan and you borrowed against the full value of your property, I don't recommend you buy it. But as you go along and you do develop equity in your home, at some point it's going to be a viable choice to protect the investment and the value of your home.
Okay. Now, insurance costs today, if somebody's wondering if it's worthwhile for them to consider having earthquake insurance, how do you come up with the cost of earthquake insurance?
In the state of California, any insurance company that insures a home is required by law to offer you earthquake every other year. Mm-hmm. So periodically you'll be getting offers. One of the major insurance carrier in the state is the California Earthquake Authority. It's run by the state of California, and that's where the majority of the earthquake comes from. Certain carriers, certain companies still carry their own insurance for earthquake. And so if it's one of those years where at the very start they'll send you an offer, but you only have a 30-day window to respond. It expires after 30 days.
Mm-hmm. dollar amount? Is there one?
It's about $2 a thousand. If your home's insured for $250,000, it should cost you between $500 or $600 a year to insure.
Very good. Thanks. Scott Rule's been our guest. Once again, he's a great friend. He's been in the insurance agency. He's been an insurance agent for 31 years. He's now with All West Insurance. And if you have any questions to Scott or myself, please go to our website, reweeklytv.com. Right now, it's your viewer mail. Welcome back to Real Estate Weekly. Brian Steichen along with Tracy Pierce and Dan Lawson. We want to thank you for your viewer questions. You can go to our website, reweeklytv.com, if you have any questions, and we look forward to answering them here. Again, starting next week, we're going to have your questions actually posted on the board, a la like Hannity and Combs or some of the O'Reilly factor. You'll have your name up there. We'll answer the question on the air, and we hope that you go ahead and do that, submit that. Tracy, what do you got?
A client of mine recently wanted to know, she co-signed for her daughter on a car loan, and she's wondering why it's being counted against her in her loan application in her debt ratios. Do one of you want to?
I thought you might want to, but
Go
no,
ahead.
just kidding. But that's an inside joke there. But the main thing is that that's the problem with co-signing, is that when you co-sign, you're actually just saying, I'm waiting in the wings. If they don't make their payment, we'll go ahead and make the payment. It's on you. So there is that kind of thing about co-signing. I mean, it's nice that she could buy a car by getting a co-sign. But the downside of it is that it's also part of your credit. So if her daughter is making late payments or anything like that, then it'll show also on the mother's credit. And
because when you co-sign, you're equally obligated for that debt. That's why it's so important to really think long and hard if it's a wise thing to co-sign for someone. Presuming that the debt is paid on time, and as you say, maybe the car loan's $450. If it's impacting her ability to purchase a home, what we oftentimes do is go to the person who actually has the car. We'll get canceled checks from them and show that they are the one responsible for making the payment, and the other person was just accommodating it because it was a daughter they were trying to help. And oftentimes the lenders understand. They're human. They want to help do loans, and they'll say, oh, okay, we understand. No problem, and then they don't count the debt.
the other thing, too, is that if there's 12 months, less than 12, actually about less than 10 months left on those payments, then they don't include it anyway. So if they see it's at the tail end of the auto loan, then that's a good thing, too. So, Dan, you got one?
Actually, I was thinking, I don't know how much time we have. We have probably another minute or two. Well, this time of year is an exciting time of year. And it's exciting not only because we get to have Thanksgiving and Christmas is around the corner and the holidays and all those things, depending on what your religious
Dan's
preference
going to have
is.
us sing Christmas carols coming American time.
Next show. But no, seriously, what I find exciting from a mortgage end is that this is the time of year that Fannie Mae and Freddie Mac announced the new Fannie Mae limits. And it's this last year of 2002, it's been $300,700. And the previous year it was $275,000, so they increased it $25,000. So there's this groundswell rumbling of what are the Feds going to do? What's Fannie Mae and Freddie Mac going to give us? Are they going to? I emailed one underwriter, and she said she thinks she's been hearing it might go to $350,000. I think that will not happen. It's just way too much. But even if it goes to $325,000 or $330,000, maybe you guys want to talk about some of the benefit that'll give clients.
Well, the one thing just off the top is that these people that had these, tried to get a conforming loan because of the pricing, they can now do it. So if they've got a jumbo loan, and right now that's considered a jumbo loan, let's say it's $325,000, and they turn around and refinance, boom, automatically they're going to save at least 0.25%.
So Trace, maybe talk about a jumbo loan, things like that, so people understand.
Well, right now the limit is $300,700, but what I wanted to point out was if people at home are listening to this and maybe deciding that they should cancel their loan, that might not be a good idea either, because if they have a great interest rate locked, there's no guarantee that when the Fed does change the break-off point that they'll be able to get the same rate. So it's something that people might be able to take advantage of in a few months, but it's definitely not a reason to stop what you're doing right now.
And if it
Don't
does
bank on
change,
it.
no, I don't have time, do I?
No, we're at the end. We'll bring this up next time, though. That's a good subject. And so, Dan, I'm really looking forward, since you've mentioned that we're going to hear something next couple.
As soon as we know, we'll let y'all know.
Please look at our website, reweeklytv.com. We thank you for joining us once again here at Real Estate Weekly. Brian Steichen along with Tracy Pierce and Dan Lawson. Good night. We'll see you next week.